Morning, welcome to Ainsley End of Week News. It's Friday, the 26th of June. Today we're talking how gold and why gold will hit $2,000 by year end. Changing it up today, we're passing on a well spelt out argument for record high gold in the second half of this year. Eddie van der Walt is editor and commentator at Bloomberg for global financial markets with his focus on commodities. He just wrote an article laying out the case for $2,000 gold before year end. We hope you enjoy. Here it is. A mix of slow growth, easy money, and black swans can propel gold to record highs in the second half of 2020. Lingering fears about lockdowns and scarring to the real economy should keep haven demand strong, but the metal could also rally in a risk-on environment, as the 2008 playbook showed. Comfortably, the best performing major asset in the past year, gold soared by a quarter. That put it within levels that markets live foresaw at the end of 2019. With a global recession arriving sooner and cutting deeper than expected, $2,000 per ounce gold is the next target. Here's the next chart here. A golden year. Bullion outperformed all major assets in the last 12 months. 26.3%. Crude had a rough one there. While central bank policies aimed at supporting employment are likely to keep equities from collapsing, the prescription is as good as a steroid for gold. Money printed off the trillion feeds the narrative of faster future inflation and keeps investors coming back to the metal, which tends to do really well when real rates are low. Having completed a rounded bottom formation after a triple top in the first half of the last decade, gold rallied more than 40% since this macro view column in 2008 predicted gains would follow a short squeeze. Check out this next graph here of old resistance. Kind of getting up around that $1,800 mark here. The years after 2008 offer a precedent for the current climate. Back then, policymakers were also aggressively applying unconventional monetary policy to boost growth. That meant gold became positively correlated with risk assets, with bad news triggering further rounds of quantitative easing, which propelled both gold and stocks at the same time. Such momentum could become self-perpetuating for gold, a Veblen good with high autocorrelation. As prices go up, more is written about it and more money flows in. Regressing price moves against these a year earlier, showing an R of 0.4 since 1990, higher than the same measure for the S&P 500 or commodities like oil and copper. Consumers of gold products have been largely absent in the first half, due to post-Lunar New Year lockdowns and higher prices. High premiums for physical metal and dislocations between New York and London prices were seen after refineries shut down along with most other industries. Pent-up demand may well emerge as Diwali approaches in India too. Besides, investor flows in ETFs and futures are more important price drivers. After a brief overshoot early in 2019, gold's speculative overhang retreated from an almost 50% to below 30% measured by COMEX, managed money net long positioning as a share of open interest. The appetite in exchange traded funds remains insatiable. Check out this next graph, battle for gold. ETF investors buy while relative futures positioning is trimmed. The primary risk to this view would be a V-shaped economic rebound strong enough to result in aggressive reductions in central bank stimulus. The latter may come if runaway inflation emerges, but seems unlikely to transpire in a meaningful way before year end. For now, policymakers are likely to remain dovish and thus indirectly supportive of gold. The dollar is bullion's biggest driver on a tick-by-tick basis. Regression analysis shows about a quarter of weekly price moves since 2001 could be accounted for by the trade-weighted dollar, which might suggest a stronger US currency is a risk. Yet, during periods of acute stress, gold's relationship to the greenback flips and both become haven assets. The inverse correlation between the two broke down during or immediately after every recession since 1981. Have a look at this little graph here and showing the inverted link between the two. Central banks are also likely to remain a backstop of buyers of physical metal during periods of weakness. While Russia and China are no longer reliable buyers, the official sector bought nearly 6 million ounces of metal through April, according to IMF data. That's the biggest increase in total holdings at that point of the year since 2013. If prices keep rising, demand in this corner may dry up. Supply is not a threat, given gold's nearly perfectly inelastic supply curve. Shares of junior miners, a high beta play on gold, rallied 38% in the last year. But any new capex wouldn't bear fruit for years to come, and recycling only matters at the margin. These factors should help gold break long-term resistance at 1800. CTAs could give it momentum to test 2011's record highs and make a price range of 1900 to 2000 realistic by year end. So that's views by Eddie van der Walt from Bloomberg. We'll be back on Monday with more news. Everyone enjoy their weekend. And remember, you can always jump into our website, ainslieybullion.com.au, for more news and for purchasing gold and silver. And check out Ainsley Wealth for all of our cryptocurrency products. We'll catch you soon.